What's up, everyone? Welcome to the daily macro update for Thursday, August 7th. Let's go ahead and get right into it here. Nothing too crazy in terms of the macro data today. We had initial claims go up a little bit more. There's still a lot of fears surrounding the United States labor market, fresh off of last week's unexpected, jobs revisions report. When we take a look at the initial claims here, and really just zoom in to the past couple years here, I mean, it's pretty much remained within this range here between 260,000 on the upper end, and then on the lower end around 190,000, and really hasn't jumped up across that sustainably, right? I mean, if we go ahead and take a look over time here, you can see that when you have these massive ramp ups, that's when you start to that's when you should have some concerns there. But really, I mean, it's stayed within historical range here. I can go back to, for example, going all the way back to the 2008 Great Financial Crisis here. And as you can see, once you get above like that 350,000 level and sustainably rise after that, you can pretty much start the time right there in terms of like we've officially entered a recession. And we haven't been anywhere close to that right now, right? So again, just going back to where we're at right now, the last time that it was spiking above this was back in 2021, but that was when it was coming off of, a lot of the COVID layoffs and stuff like that. So that was when the labor market was coming back into balance. And as you can see, even though there's been a little bit of a spike here, it's nothing to be really concerned about, right? It's staying below that 260,000 jobs level. So yeah, what is a little bit not concerning, that's not a great word, but I would just say what's notable to observe is the amount of continued claims after initial claims has steadily continued to rise. And, that really started to ramp up towards the summertime here. And so, you want to make sure that you're also paying attention to not just initial claims, because that's really what a lot of people just hyper focus on every single week. You also have to take a look at the continued claims, because, if you have continued claims declining, that's good news, right? Even if you have a 1 week or 2 week spike in initial jobless claims, as long as like the long-term, 4 week average of continued claims is going down, that's still okay, right? And so I kind of like to lean on more so the continued claims, because that means there needs to be more people who are continuously asking for government assistance, right? Kind of makes sense. And, similarly, going back to, the Great Financial Crisis, whenever you see a continued, rapid acceleration in continued claims, you gotta pay attention to that. And so obviously, we're not anywhere near those levels, right? We're still at historical low levels. So even though there was a huge freak out last week in the labor market, you still have severely low continued and initial unemployment claims. And so I think a lot of the freakouts that happened last week in terms of the labor market, might be short-lived. A lot of what happened was not completely attributed to, but definitely attributed to the way that they calculate and are, getting the initial readings, right? Because obviously, if, the initial readings continue to come in way overestimated, then there needs to be some type of change in the way that they're gathering this data, because we're just not seeing that concern reflected in the initial claims data, as well as the continued claims data. So I think that, the entire freak out that's going on right now in the labor market will subside as the months go on, and there'll be a refocus shift on inflation concerns, which nobody is even thinking about that right now. So, when you take a look at the United States consumer inflation expectations, that actually had a tick up to 3.1%. So, I think that inflation concerns are going to come back. As you guys know, if you follow me on X/Twitter, whichever one you prefer to call it, sometimes I refer to it as X, and people are like, "What are you talking about? What is X?" Twitter, X, same thing. We've been pretty much going back and forth with this, what I like to call, and what my team likes to call, the stagflation ping pong with the 10-year U.S. government bond yield. And so when you take a look at this graph here of the 10-year, and the reason why, you pay attention to the 10-year U.S. yield is because, this is one that no one controls, right? The Fed doesn't control these yields. The government doesn't control these yields. This is pretty much the best you can get in terms of, free market pricing in inflation and growth expectations. And as you can see right here, pretty much since mid-November, anytime that the U.S. 10-year government bond yield has gotten down to like 4.2%, and that's typically either off of recession fears, labor market fears, or the ramp up in government buybacks that we're seeing, which is like a stealth QE, basically pseudo yield curve control, which I'm not hearing anybody talk about. I'm doing a deep dive video on that pretty soon. But yeah, the government is manipulating the long end of the yield curve with the amount of short debt that they're issuing, as well as the massive amounts of government buybacks that they're doing with that short issued debt. Anyway, just take that with downward pressure on the 10-year. So you have those forces, right, on all these different occasions. But then once it gets down to this 4.2 level, inflation fears start to come back, and it's like, wait a second, the Fed can't really cut right now because of inflation still remaining well above target. And it's not just me saying this, okay? When you take a look at the Cleveland Fed's inflation nowcast here, let me just update this. You can see that even for the July number actually has that coming down to 2.7%. So we could actually see a 1 month deceleration in headline CPI, which, man, that would get a lot of people riled up, right? That would be significant because a lot of people would be calling for the Fed to start cutting rates, but you have to realize that the Fed won't cut rates until they see a sustained downtick in inflation back down to their 2% goal, right? So if inflation continues to remain sticky and it ends up actually reaccelerating in the August print, which gets reported in the month of September, approximately, 10 days before the September FOMC. So you could see a crazy whipsaw go on right now in terms of rate cut expectations because, I just don't see the inflation problem going away anytime soon. Let me just see here. I forget what headline CPI is at right now. Maybe somebody could put it in the chat. Okay, right now it's 2.7%. That's right. 2 month acceleration. In April, it was 2.3. So pretty large, acceleration here. We have expectations going higher. And then, we have the July print staying steady at 2.7. And then it revamping up to 2.9% in August. That gets reported in September. Core CPI remaining squarely at 3%. That's not 2%. So, yeah, I think that a lot of people are missing this right now. Let me see. Let's go to the core inflation rate. Let's go 10 years. Okay, so here's the United States core inflation rate, which gets rid of the volatile components of CPI like energy and food. And so as you can see, pretty much the standard pre-pandemic average for this was around, 2%. Because that's kind of where the Fed wants to get it to, right? Well, as of the last print, it's at 2.9%. And the Cleveland Fed has that going up to 3% and staying there. So again, people, I think people are just not paying attention to CPI. All right, we beat that dead horse. Let's go ahead and move on. Let's go on to the markets here. Let's pull up some of the charts. Taking a look at U.S. oil, this is pretty interesting, seeing a breakdown here. This went to neutral a couple days ago in our model here, and it could actually go bearish. So this is definitely a new development here, while at the same time, the dollar could also be heading back to neutral. And so these are both positive, reactions, from the market. It could also be signaling more of a issue of slowing demand. So, we'll see what happens there. U.S. 10-year yield, still having a 3-day acceleration, bouncing right off that 4.2%, level there. The volatility index of the S&P still, remaining around that 16%. Not really huge, not really a huge move there. Gold continuing higher here. Man, look at this crazy just whipsaw in gold that we've pretty much been bouncing between, since the end of April there, right? We'll see if it has another crack at $3,434 per ounce of gold. Yeah, and this just keeps fluctuating between neutral and bullish in our model here. And so, if gold is staying steady at these prices, I mean, that's also an indication that inflation is remaining a problem here. Silver prices still remain bullish. Platinum prices still remain bullish. Palladium, right? Aluminum, all these things that are inputs in the economy, these base metals continue to rise. Let's see here. Bitcoin having a little bit of a pop here towards the top end of the trading range. Good time to sell some Bitcoin if you guys own it, according to our process, not financial advice. And then let's see, the S&P 500. We're about to close here momentarily, having a little bit of a down day, lower volume. Pretty interesting there. This morning was a huge sell for some profit signal. Take a look at that bounce in Amazon. This was actually one of the moves that we were buying on the dip on that Friday. So Amazon was on one of the buy lists there. And for those who were in our group, got it, we're able to capitalize on that little 5% move. And now we get to sell some. That's the great thing about tracking the macro and having a process that tells you to buy when other people are freaking out. Now, these ranges here that you guys see, we publish these every single morning for free for the people who are subscribed to our free newsletter called the Daily Index Ranges. And so if you guys would like access to that, just go to the link below. You can just put in your information there, and then every single morning you will receive the trading ranges for the NASDAQ, so QQQs, the SPY, as well as the Russell 2000 small caps with IWM. So if you guys are looking to get those every single morning in order to make sure that you are not being distracted by the news or your emotions or whatever, then I would highly recommend taking a look at that. We won't spam you. It's just for that index, or for those for that newsletter. So, all right. With that being said, let's go ahead and get into some questions here, and then we'll go ahead and wrap it up. Okay, so let's see some of your questions here from Instagram. Why does the inflation rate have to be 2%? That's a great question. PB.0316. It's a made-up number. It's a made-up number by the Fed. I think it's, I forget which Fed chair actually made up 2% as like the target. So Julian says 2% is small enough so people can barely feel it and don't complain to the point where civil war would. Yeah, that's actually quite true. 2% is kind of like a steady state level where nobody really questions it, but at the same time, you're still getting, inflation increases over time. It's easier to increase wages at that low level as well, while also expanding profit margins at an even faster rate, right? So you can pay people less and make more profit if, things are at 2%. All right. So somebody posted that Trump signed the executive order opening crypto and retirement plans. Yeah. So the part of the reason why there's a huge rush to go for this crypto thing is because the government needs cash like right now. It's quickly running out of money, and when taking a look at the TGA, that has pretty much been floored. The RRP, that's basically out of money now. That's there's hardly any liquidity there. 77 billion from 2 trillion in just 2 years, so that's been cashed out. The Fed or the Treasury Department has said that they are going to continue issuing bills at the short end, and then also as well they are ramping up cash management bills, which are custom maturity, issue on demand in the chance of a cash funding emergency. Those have also been ramping up, which is what I've been looking into recently. And so what the government is trying to do is open up the doors to a lot of this liquidity and pent up cash, because that's all they're trying to do right now is push these things in order to create a Band-Aid so that they can just increase the total amount of time that they have until the Fed actually cuts rates, right? That's all they're doing. They're trying to buy time. They're trying to can kick as much as they can. So this whole race for crypto is just another way for the government to secure cash, right? So a lot of people who are super excited about all this awesome crypto stuff that's going on with the government, hoorah, man, the Trump administration is super pro crypto. No, they're super pro trying to get cash right now. So that's what's really going on. All right, let's go to some questions over here on the TikToks. All right, let me just scroll. I really need to find a better way where I can track your guys' questions on TikTok, because it just keeps on scrolling here. One second. What are your thoughts on the reverse carry trade in Japan and the impact on global markets? Yeah, that's still a thing. I mean, Japan is seeing inflation rise, and they have a hawkish CBJ. So I mean, that's something that's definitely a change. So yeah, that's definitely a risk that's out there. Kathy says, "Hi, Johnny. I enjoy learning much in the courses. Watching more tonight. Great. Yeah, welcome, Kathy. Great to have you in the group there. Hopefully, you've been learning as much as you can in there. And if you have any questions, just let me know." I sold everything today. This isn't me saying this. I'm reading a comment. I sold everything today. Made 67% for the year, so I won't feel too bad if it keeps going up. Why'd you sell everything? It's still in bullish trend. Check out the bookshelf in the background, the S&P 500 trend bookshelf color in the back. It's still green. It's still bullish. What about New Zealand recession? Are they in recession? I don't know. I mean, taking a look at ENZL, the New Zealand ETF, this currently remains in a bullish trend. So, I mean, yeah, series of higher highs and higher lows. I don't care if New Zealand is in recession. The ENZL ETF remains in bullish trend. Thoughts on the jobs revisions? Yeah, I mean, obviously it's not looking too great for the jobs market, but I think they just need to do a better job with reporting reality at that initial reporting, instead of, because I think people are now starting to observe these jobs revisions And so by sneaking them under the table after the headline jobs report comes out, I don't think it's working anymore because people are just going to keep paying attention to the revisions number. So you might as well just report, the best, you might as well report that the actual number as close as you can. Or maybe figure out a way to get people to respond to these surveys better because let's face it, when somebody calls your phone number, that's like a random number that 1-800 number, are you going to pick up? No, nobody answers spam calls anymore. And even if you do answer the call and it says, "Hi, I'm with I'm here to take a survey." Click. Who answers surveys anymore? I don't get it. Why can't they just send out a mass government text message to everybody and it says, get $10 wired to your checking account if you do this survey? That would probably get some accurate numbers, right? Should I run for office? No, I should not. That would be bad. Let's see. I think there's a little chop coming, possibly. One important note: the stocks I sold are all China. I mean, China continues in bullish trend as well. You know, so I mean, China is actually doing pretty well. If you take a look at the Shanghai here, take a look at that. Look at China. Bam. It's because they're printing trillions of dollars right now. But interesting. The preferred ETF is EWH. If you're someone based in the US or Canada and you're trying to have exposure, EWH on dips. Okay. Okay, here's the Earth. Round. You guys remember that old YouTube video? Fires and missiles. Is crypto altcoins still in a bullish trend? Yeah, some of them are, but not all of them. Because they would tax you on the $10. That's true. Or it would just be a $10 loan, and you had to pay it back with interest because the government, man, every time they give handouts, there's always strings attached. Let's see. Bum. How are you prepping for the 2026 recession? I don't know if there's going to be a 2026 recession, right? I'm sure you're referring to the video I made a couple days ago. Yeah, what I'm seeing is that there's obviously a runway timeout to the amount of band-aids that the government can keep doing. And, that's going to run out soon. I mean, we're seeing their options run out, with the RRP drained, with the TGA basically floored. And the risk, the risk of rollover risk continues to accelerate the more that we maintain this situation where rates remain high and the government keeps on issuing debt to finance itself on the majority of treasury bills. They're still issuing bonds and everything else. They're just heavily weighted more on bills, right? And you can't do that for long, especially at these higher rates, because the more bills you issue that are maturing anywhere between 3 months to a year, well, once those mature, you're going to have to refinance those, and it gets harder and harder to refinance as that grows. You just can't do that without something seriously breaking in the bond market. That's when you're going to start to see yields just go crazy because people are going to demand way higher premiums to own paper. So that runway, from what I have noticed, could or has a high probability of coming due somewhere in 2026. I don't know where, I don't know how, and I don't know what magnitude. So it could, we could see a slowdown. I mean, you're already seeing it right now. There's already pockets of recession within the United States, right? When you take a look at the housing market, right? I mean, you take a look at housing demand, that's definitely in a recession right now. When you take a look at manufacturing, manufacturing is definitely in recession right now. When you take a look at the bottom 50% of retail, those people are definitely in a recession right now. They've been in recession since 2021, right? So in a lot of parts of the country already, they are in recession. Wait, what I'm referring to is an aggregate recession, which is like when everything is doing bad. And the main cohort that is holding up an aggregate recession are the top 20% of wealthy people in the United States, because the top 20% of earners and wealth asset owners, they contribute to 60% of all of consumption in GDP. And so you have this situation where, there's a small amount of people who contribute the vast majority of consumption and economic growth in the United States. And so if rich people continue to feel okay, which I mean, stock market's making new all-time highs, they check their retirement account, hey, things are looking pretty good. That wealth effect is going to take hold, and they're going to see their retirement account higher, and they're going to go out and spend more. They're going to go ahead and feel more comfortable buying that boat, buying that more expensive house, doing these things that are going to keep promoting fake, consumption. It's not fake; it's real consumption. But yeah, I mean the upper classes of the United States are really what's holding up the entire economy from having an aggregate recession. I sold because of fears of possible tariffs on China buying Russian oil. Oh, okay. Well, I mean, big buyback activity, big back activities. I would never make investment decisions based off of possible news that might happen in the future. That's not a very good investment process. Okay. Take, for example, all the people who thought that the world was going to end in 2023. I was in that camp for a few months until I realized that the market just doesn't really care. But if you would have just made a trading decision because of fears of possible recession in 2023 or 2024, you would have missed out on, the two of the best back-to-back years in the S&P 500. So yeah, big back activities. I extremely encourage you to research more on making trading decisions based off of hypothetical things that could possibly happen in the future that is not happening right now. All right. Kathy asks, are you live daily at this time? Yeah, we're live. I'm live every single day from 3:45 typically until about 4:20 or 4:30. So we'll probably wrap up here in the next 5 minutes or so. But yeah, I'm on these lives daily. Jack, appreciate you encouraging people to hit the like. Thank you, brother. All right. So hopefully that makes sense. Let's see. We just closed here. What was the big? It looks like Meta had a decent down day today. Or not really. Still remaining near all-time highs, but a little bit of a sideways action here from the S&P. Interesting. Making a lower high right there. We'll see what happens. Volume is still pretty decent, but we'll see what happens from here. But all right, everyone, we're going to go ahead and wrap it up there. I appreciate everyone for joining. As always, if you guys have any questions, shoot me a DM, visit our website, and then we'll catch you tomorrow in tomorrow's daily macro update. Bye, everyone.